Hey everyone, Nick Paynes here with Remax Alliance and the Meta Homes team. Wanted to take a quick opportunity to teach a little bit about appraisal gap and appraisal gap language, and an additional kind of form of manipulating our contract and the lending to make the best possible offer when it comes to appraisal gap. So wanted to go over a quick presentation with you guys and show you how we can offer appraisal gap and not have to come out with as much out of pocket as maybe we think we do. So let's go through this, and hopefully you guys will get a good understanding. And if not, please reach out to your agent from the Meta Homes team that can help you explain this a little bit more in depth. So first of all, appraisal gap is kind of a necessary component in our sellers market that we're in today. So first piece is, what is it? Appraisal gap coverage is when a buyer agrees to cover any difference between the appraised value of a subject property and the offer price. It's written into the addition section of our real estate contract. Why do we offer this? So why offer appraisal gap? In a competitive seller's market, an appraisal gap shows the seller that you are serious about your offer. Okay? It offers some security to the seller in the event that the appraisal comes in lower than your offer, that you'll still pay the offered price. It can also serve as an incentive to the seller where the buyer pays a certain amount, say $10,000 over the appraised value, up to your offer price, regardless of the appraised value. Okay, so let's look at an example. So 123 Main Street is listed for $400,000. There are currently multiple offers on the property. The highest offer is $435,000. After pulling comparable sales, you believe that it will be difficult for an appraiser to find support for any purchase price over $400,000. In this case, you want to suggest to your client that any offer over list price should be accompanied by appraisal gap, and you suggest an offer price of $440,000. Okay. So there's two different verbiages that we kind of offer in the contract. So the first one looks something like this. The current listed asking price of the property is $400,000. The purchase price is $440,000. If the property's appraised value is less than $400,000, so less than list price, then the buyer has the right to terminate this contract or object to the appraisal on or before the objection deadline due to low valuation. If, however, the property's appraised value is at least $400,000, but less than $440,000, so between $400,000 and $440,000, then the buyer does not have the right to terminate or object due to low valuation, and the buyer will provide at closing the necessary additional personal funds as part of the cash at closing amount. Okay, so that's number one. We would call that full appraisal gap. It covers the entire amount from list price to offer price. You may also have some verbiage that looks like this. So this is a different way of putting it. In the event that the property does not appraise for $440,000, buyer agrees to pay $20,000 over appraised value, not to exceed purchase price. Okay. So in the first example, the buyer is committing to cover up to $40,000 in appraisal gap, while the second example is a set amount of money over appraised value. So $20,000 in appraised value. Property appraises at $400,000. Buyer agrees to pay $420,000. Okay. All right. So let's talk about who can use appraisal gap. So how do buyers pay for appraisal gap? This is where appraisal gaps are tricky. There's a common misconception or misunderstanding that buyers must pay for their appraisal gap out of pocket. Okay. This means that if a buyer offers $40,000 in appraisal gap, they need to have an additional $40,000 in the bank above and beyond their down payment. So that's not necessarily true. This mentality kind of limits well-qualified buyers from making competitive offers because they believe that they have to have their down payment plus the $40K. Okay, so as an agent, and what I teach agents is that the agent and the lender need to understand how the appraisal gap can kind of be financed within the loan and how we can actually limit the out-of-pocket costs to significantly less than the promised appraisal gap amount. Okay, so let's explain how this works. Okay, first of all, my full disclosure with this is that you need to have a good lender that understands these investment strategies or these appraisal gap strategies. Okay, so the following information should be discussed with your client, with your lender. Obviously, if you're watching this as an agent, you should talk to your client about it. If you're watching this as a client, make sure you talk to your agent about this. Okay, so if you need a good lender, you should talk with our HMA rep that's within Remax Alliance. He's fantastic. He understands this this approach to appraisal gap fully, and is very knowledgeable about the product. All right. So who can this strategy help? So any buyer that has not already maxed on their debt to income. Okay. So if you've been approved for $700,000 purchase price, but you only want to purchase something in the 550 range because that's the payment that you're comfortable with, this will work just fine for you. Okay. You also need to not be using a minimum down payment loan. Okay, so if you're doing a 3% conventional, a 3.5% FHA, or a 0 down VA, this will not work for you. This only really works for people who have the intent to put 20% down, 15% down, 10% down, something that's not minimum. Okay, so this strategy will work with anything. If you're 5% down, this will work as long as you're a first-time home buyer. So it'll work in some way, shape, or form. Okay, so let's talk about how this strategy works. Okay, so how can we limit our out-of-pocket costs? So now that you know why gap is so important and who is able to use the strategy, I'm going to use a typical example in today's market to show how you can offer gap at a fraction of the amount that's offered. Okay, so our scenario. And this can be a little bit confusing, so you may have to watch this part of the video a couple of times or refresh with your agent. Okay, so let's start with some facts. 123 Main Street is listed at 400,000. Buyers want to offer 440,000 and include full gap coverage. Okay, the buyers are using a conventional loan and they're currently putting 20% down. They plan on putting 20% down. Okay, so 20% of a $440,000 offer price is a $88,000 down payment, and you would have a loan amount then of 352. Right, 440 minus 88 is 352. Okay, we don't believe that the property will appraise for 440, or honestly, even if we do believe it'll appraise for 440, sellers still want to see that gap. Okay, so how do we convince our buyers to make such big offers? This is, again, whether I'm talking to you as an agent or talking to you as a client. How do we talk to you, or how do I let you know that you should make this offer? Okay, so the problem with our previous scenario is that our buyers generally think, that $40,000 in gap means that they need to increase their liability or their cash out of pocket to $128,000. So they're thinking, okay, I got to put $88,000 down plus $40,000 in gap. It's not, this isn't true. There are two ways that we can save you as a client $40,000 out of pocket. I'm going to show you how. Okay, the first option is this. We'll show the increased monthly payment that it would cost to finance the entire gap amount. Okay, so how do we do that? Here's the scenario. Again, let's say your client offered $440,000 for the $400,000 house. They offered $40,000 in gap, and the property does appraise low for the list price. Here's what the clients are going to do. So here's what you're going to do as a client. The clients, okay, will still pay $88,000 out of pocket as planned. Therefore, the loan amount is still $352,000 as planned. That doesn't change. The only thing that changes is the down payment amount on the property. Okay, not the out-of-pocket amount. So really the only thing that changes is the loan to value. We're basically taking $40,000 from our down payment and we're allocating 40 of it to our gap, and we're allocating 48,000 towards our down payment now. So in the lender's eyes, the lender's saying the property is worth 400,000, a $48,000 down payment is a $352,000 loan amount. The only thing that changes is the loan to value. The lender no longer sees this as a 20% down loan. They see it as like a 12% down loan. Okay, so in that case, what happens? Well, at 20%, we eliminate mortgage insurance. So at 12%, now we have mortgage insurance. That's the only difference. Your monthly payment is still the same because the loan amount is still the same, but now we do have an additional monthly payment cost of MI. Okay, so according to the lender, we just talked about this. Therefore, the buyer will change their down payment. Sorry, I talked about this before I pulled the slide up. So the buyer planned on paying $88,000 out of pocket, and their down payment is now only $48,000. Buyer has an extra $40,000 they're not using towards gap, or that they're not using towards their down payment. They'll use the rest to cover gap. Okay, so the way this works is the buyers are no longer putting 20% down, so they have the MI. Using this strategy, this is the only added cost the buyers take on. And in our current pricing scenarios, the additional monthly cost of that MI is $90 to $100 per month. Okay, so if you've got good credit, you got good DTI, that $40,000 in gap will cost you about, instead of bringing 40 to the table, you can choose to pay $90 to $100 per month extra. Okay, so the client covered $40,000 in gap by paying the same out-of-pocket $88,000 by essentially financing the $40,000 in gap at $90 to $100 per month. Okay, that's option number one. You increase your monthly payment a little bit so that you don't have to bring a big chunk of change to the table. Okay, here's option number two. Option number two is you can find out that $90 to $100 per month, you can actually buy that out up front. Okay, so find out what it would cost for the client to buy out their MI with no additional costs on the loan. So in this example, that $90 to $100 per month can actually be bought out between $4,500 and $5,000 up front. Okay, so you're essentially able to finance the gap, the $40,000 in gap, for less than $5,000 out of pocket. So you can plan to have $88,000 down, for example, or out of pocket, and then offer an additional $40,000 in gap, and for as little as $5,000 extra. So instead of 88, maybe 93, you can cover that entire gap amount, and nothing else changes. So your monthly payment stays the same. It all stays the same. Okay, so you basically have two options. You can take a small monthly increase in payment, or you can do a one-time lump buyout sum. And you can, even if you didn't have more than 88,000, you can again drop your down payment a little bit more. So instead of being $48,000 down, be like $43,000 down, and then you can take the extra $5,000 and pay off the MI lump sum there. So you can still do this and actually still only be $88,000 out of pocket. We're just going to have like a loan to value of like 10% now, and then we're going to use that extra 2% that we saved to pay off the MI difference. Okay, so let's talk about one last thing. So how are we using this? Okay, so again, this portion might be more for another agent, but it can also be beneficial for the client. So you need to have a lender that understands this concept, and then I have kind of an action plan that we use that puts you through the steps, and we ask you some questions and we see, do you qualify for the gap? Okay, so that's really the biggest piece here. We just need to know from your lender that the client has some room in their DTI to make this work, and kind of find out where the MI is going to be. Okay, so that is the most important part of this. This gives you a little bit better understanding of how we can finance that amount of gap if you originally intended to put a larger down payment down. You just reduce your down payment and pay off the mortgage insurance that would have made the difference in your monthly payment. So if you have questions on this, please feel free to reach out. It is kind of a difficult concept to grasp, and a lot of times if we can put some more numbers down in front of you and show you how it works, or even show you in your own individual situation how it works, we can help you with that. So thank you so much for your time. Thanks for checking out this video. And please feel free to reach us again, Meta Homes team with RE/MAX Alliance.